Hello everybody, welcome to my channel. Today I'm going to talk about the topic on 6 things I wish I know before trading any stocks. If you don't know these 6 important things, you better not trade any stock. These 6 things are the most commonly ignored by people who just started trading. Failing to do so will result in huge failure. If you have not subscribed to my channel, please hit the subscribe button now so that you can get alert on future investment videos like this from me. Thank you. The most important part of trading is risk management. Let me explain this with an example. Suppose you have $10,000 capital and you identify a good stock to trade. So, your strategy says that you should enter the trade at $2. Then, your strategy also suggests to you if the price falls, you will cut loss at $1.50. Good. You have established when to enter a trade and when to cut loss. Then, should you just start trading? Actually, the answer is no. You must also determine 2 more important questions. First one, how much money to risk per trade? This is the maximum amount of money you could afford to lose if that single trade lose money. Note, this is not your capital. Next, after answering how much you willing to lose per trade, you must ask yourself how many unit of share to buy. Notice I haven't touched on when to take the profit yet, and I only talk about what to do when your trade lose money. Don't worry, I will come into that later on in the next few slides, because managing your risk per trade and sizing your trade is the most important things to do before a trade takes place. So, let me illustrate more on the first point, how much money to risk per trade. Imagine if you decide to risk 10% of your capital for every trade. Just the first trade alone, if it fails, you already lose $1,000. If you are so unlucky that you lose consecutively 2 times, your capital now drops to just $8,100 and you lost $1,900. In fact, if you are very unlucky and lose consecutively for 7 trades, your capital will be less than half, losing about $5,200 in 7 trades. Now, look at another case where you just risk 1% of your total capital. For every trade you made, now look at the table. You can see that the loss of first trade is just $100. Even if you are so unlucky to lose 7 trades consecutively, you only lose about $680. This is capital preservation. The more you risk per trade, the faster you will wipe out your account. It is not impossible to lose consecutively so many times. In fact, it is very common to be on a consecutive losing streak for most strategy. For example, a strategy with 70% probability of winning also means 30% of losing. It could also mean that the first 30 trades you are making losing trades. So, the ability to preserve capital through the first 30 trades will allow you to wait for the next 70 rounds of winning trade. You wouldn't want to get wiped out before you even see your first winning trade. Next, sizing your trade to determine the quantity of share to buy. You will use the max amount of money to risk per trade, which you have determined in the previous slides, and divide this amount by the price gap between the entry price and the cut loss price. So, using the same example where you enter the trade at $2 and cut loss at $1.50, the max amount to risk using the 1% of your $10,000 capital is just $100. Finally, you can calculate the quantity of shares, which is equal to your max amount to risk, $100, divided by the price gap between your entry price of $2 and $1.50, which work out to be 50 cents. And this will give you 200 shares. So, this is the proper way of how to determine the number of shares to buy. You have to work backward from the amount to risk per trade to determine the quantity to buy. If you are serious about trading, I highly recommend only using strategy that you could automate using script or any tools that the brokerage provide. This will give you a way to test your strategy, which is very important. If you can't test it, how would you know it will work? Yes, past not equal to future performance, but if it can't even perform in the past, what makes you think it will work in the future? So, in order to automate, you need to have clear and well-defined rules, which are when to enter a trade, what is the condition to entry, when to cut loss. If you have no stop loss, you are exposing yourself to unlimited risk. And when to take profit. The situation can change for favorable trade. So, your strategy must tell you when you should take profit and exit. So once you have all these rules, you now could automate and test your strategy at scale on many years of historical data across different stocks. Only by testing, then you know your strategy will work or not on all the stocks, or is it only a certain stocks, and is it consistent across time. You might ask, why backtest your strategy? Backtesting your strategy is not only to ensure the strategy works in the past, it is to extract important information about this strategy. Not every strategy is created equal. You need to know what is the probability of winning a trade by backtesting. You will be able to empirically determine how many percent you are likely to win. You need to know what is the average drawdown you are likely to encounter before a trade turns positive. Sometimes you might want to use these figures as well to adjust your cut loss price as well. However, not all drawdown will eventually turn to a winning trade. So over here, it's really a trade-off between the risk and the reward that you really have to determine yourself qualitatively. By backtesting, you can also statistically observe the profit and loss in terms of percentage. This is important to calculate the expected gain or loss together with the probability of win. We will discuss this more details in the next few slides. You then also can observe the average number of trades that is possible with this strategy. This is important as well. No strategy is going to be 100% right all the time. Imagine if your strategy can only generate one trade per year and it fails the trade that year. So it means you won't have any chance to make a winning trade for that year. If the winning probability is 70%, it also means that you might have a chance to lose consecutively 30 times before you start to win. Which means you have to wait 30 years before you can even see a single winning trade. This kind of strategy is not practical. So by backtesting, it allows you to find this important information out before you even use it. So with point 1 and 3, you can calculate the expected profit or loss per trade. With point 4 and 5, you can also calculate the expected loss or profit per year, assuming if you reinvest your profit after every trade. The whole idea of backtesting your strategy is really to know point 5 and point 6 to be sure that you really can generate significant positive returns per year. Realistically speaking, if your strategy doesn't even generate greater than 20% of return per year, you might just as well invest all your money in S&P 500 ETF or any other index, because it just doesn't worth the effort for you to do this kind of active trading with any return less than 20% annually. In these slides, I am going to illustrate how to calculate the expected profit or loss using two strategies as an example. In the first example, after running the backtest, strategy A produced a 70% chance of winning. The average drawdown is about 2%. Suppose you set the cut loss at around 3% and the average profit per trade is 1%. This means the expected profit per trade is equal to 70% chance of winning multiplied by average profit of 1% minus away 30% chance of losing multiplied by average loss of 3%, which is equal to negative 0.2%. Though this strategy has high probability of winning, it doesn't necessarily mean it will generate a positive expected return per trade. In this case, if you use this strategy, you will guarantee to lose. In real life, strategy of such performance actually exists. If you use Bollinger Band, short the stocks when it hit the upper band, long the stock when it hit the lower band, it might actually generate high probability of winning. But it also gives you small profit with higher loss. So it might generate negative expected profit. So this also highlights that even the strategy has high probability of winning, it doesn't mean you will get a high return. In the second example, we backtest the strategy B and it only produced 10% chance of winning. A drawdown of 2%, we set the cut loss at 3%, but the average profit it made per trade is around 50%. So, using this value, we can calculate the expected profit per trade to be 10% of winning multiplied by the average profit of 50%. Minus away 90% chance of losing multiplied by average loss of 3%. This worked out to be a positive 2.3% returns per trade. This kind of low probability of winning strategy still managed to generate a positive expected return. Actually, such strategy exists in real life as well. If you use trend following strategy like moving average strategy, which long the stocks when it crossed the MA line and short the stocks when the price crossed below the MA line, this kind of strategy will generate very low probability of winning, typically around 10 to 30%. But when it works and you let the profit run until you return back to the MA line, you will typically earn a huge profit from this kind of strategy. That's why don't fixate at high probability of winning strategy. You have to backtest it, you have to calculate the actual expected profit or loss to infer whether or not this strategy will work. And I will make a video in the future to illustrate this using real strategy, backtest on real historical data. So stay tuned. In the previous slides, we have calculated the expected profit you could get per trade. Lastly, I'm going to show you two examples on expected profit you will get per year using frequency of trade per year. Imagine we have tested the strategy A and it has a 10% chance of winning, average drawdown of 2%, cut loss at 3%, average profit of 50%, and we observe a average frequency of 10 trade per year. Therefore, the expected profit is 2.3%. Doesn't sound very impressive because you could easily exceed this with bond or passive index investing. However, using average 10 trade per year and we leave the profit reinvested, we could actually generate a 25.5% per year because you are actually compounding the 2.3% returns 10 times in 1 year. Honestly, still not very impressive compared to passive investing on index. Next, we investigate if we tweak the strategy a bit and it still generates the same set of stats, except the frequency increased to 30 trade per year. The expected profit still remains at 2.3%. However, now if you were to compound this 2.3% 30 times per year, that will actually give you 7.8% return in 1 year. Now this is attractive return which might worth your effort to do active trading. So in reality, it is possible to achieve higher frequency of trade per year. You can actually adjust the period of the moving average technical indicators to a shorter period, and that will actually generate more trade per year. However, there will be trade-off using such technique. Usually the probability of winning also drop because there are more noise, more choppy trade. So That's why it results in a lower average profit per trade. So there are trading trade-off in doing such adjustment. We have come to the end of this video. These 6 things is really very important if you are interested in trading stocks. Throw away any strategy if it fails any of these 6 points. It is true that past performance might not guarantee future performance. However, if a strategy cannot even perform in the past, what makes you think it will perform in the future? If a strategy cannot be clearly defined, then every trade is almost like based on intuition. It is then not easy to replicate the result, and thus it will not produce consistent result. These 6 points is really to help you to find strategy that works. Don't blindly start trading or fall into fake courses that teach you strategy without teaching you how to test your strategy. You can easily create strategy that sounds impressive, but for it to work, not many strategy will actually work. So thank you for watching this video. If you like my video, please help to support me by liking my video and subscribe to my channel so that I can continue to make more video like this for you in the future. And also, in my next video, I will make a video using real strategy and show you how to test it on historical data and generate all these figures to determine how effective are those strategies. If you like to see it, stay tuned and see you again. Thank you. Bye bye.